All right. Hey, everyone. It's Patricio here from Abstract yet again with another webinar. And today I have the pleasure of having Mark Wald on board. And if you've talked to anyone in the LA community, either a VC or a startup in the LA community, good chances that they've talked with Mark Wald, have worked with him, or have at least heard of him. So I always say he's a celebrity in the venture capital and tech community in LA. So. He is the founder of Supercharger. They're a professional consulting firm focusing on accounting, finance, and tech. And it's spelled Supercharger without the vowels, which I'll definitely want to ask, why you spelled it like that in a bit. But we're excited to chat today about what he's seen happen in the VC market, having worked with a ton of startups over the past decade, and sort of what are the key KPIs that matter when it comes to building a business. We'll also talk about what it looks like to build a company with slower sales cycles, and finish off talking about AI, because of course we want to talk about AI and how that's transforming work in his space. So without further ado, Mark, would love to hear a quick intro and background about your career and what led to starting Supercharger.
Sure. Thanks for having me, Pat. That was a very flattering intro. So I grew up in Silicon Valley, studied economics at university, worked in finance and accounting. I learned very quickly that I liked playing with numbers and data in spreadsheets, so that kind of drove my career. Turned into a fractional CFO, built a firm around myself, and here we are. So that's Supercharger. And it's spelled without the vowels on purpose, because I wanted the company name to have the word supercharger in it, but it was too long to type. So I thought maybe it would work without the vowels, and came up with the tagline, cut out the vowels, get there faster. Because that's what we do with our clients. We look for ways to leverage technology and smart thinking to work smarter, not harder, and get the work done in less time with better results.
Yeah, and in full disclosure, we actually do work with Supercharger. I do think they're one of the better. I can't say the best, right? Because I've not worked with every firm out there, but they're one of the top firms out there if you need help with your CFO services and accounting, all that fun stuff that founders should not be doing in-house, at least in the early stages. So with that, Mark, I'm curious to hear your thoughts on what you've seen happen in the VC market, especially over the last 2 years. Some people call it, sort of bubble that happened across startups and venture capital. So curious to hear your thoughts on what happened, and then maybe we can touch on core KPIs that are tied to raising that capital.
Sure. So with the COVID-19 pandemic, there was a lot of government stimulus money flooding the US economy and into small businesses and startups. That's like non-dilutive capital that VCs get really excited about. Also, some of those funds made its way into the pockets of business owners that invested as LPs in venture funds. And so it was like a circular feedback loop that was just flushing VCs with cash that they were excited to deploy into the market. So we saw a really big spending spike, like double the amount of VC investment, I think in 2021. And that cash was burnt through over a couple of years, and now money's a lot harder to come by. Interest rates are a little bit higher, and you have to have better fundamentals to attract VC capital now.
And those fundamentals, how did you see that shift over even just the last 2 years in terms of KPIs that VCs are looking at?
Well, VCs are in the business of deploying capital, and they have time is not their friend. So they have to make quick decisions. And when money's cheap and there's a lot of competition to invest in startups at the right valuations, then you've got to find shortcuts. So VCs look at, they pick KPIs that they understand. They try to benchmark different potential investment companies against each other. And so they'll look for things like, gross margin, churn rates, customer acquisition costs, CAC, user counts. For early stage companies, it's hard to measure customer lifetime value, because if the business has only been around for a year or two, you need to extrapolate out into the future, and you don't have empirical evidence to prove that. But basically finding some metrics that they understand and then benchmarking them against what they think is like a threshold that shows that the company is investable according to their criteria.
And what has your experience been working with early stage founders on this? Where do you think either your firm or other firms have been able to help founders with this sort of work?
Well, definitely doing scenario planning with forecast models to say, what if we change this, or we price the product here, or what if this happens, then what's the outcome? And really, investors want to invest in a company that has an interesting product that's in a growth market with some defensibility, but also in the people themselves, the founders. And so, as a founder, if you can speak intelligently with confidence about your business, your differentiator, your strong fundamentals, then that builds the confidence in the investors to want to invest in you.
And do you think I always had I always went back and forth on this because I don't think having a firm like yours makes sense right at the beginning, especially when there is no capital. So I mean, I have my thoughts, but I'm curious to hear where have your type of firms like usually come in to help companies? Is it after the first VC check, or at least for a venture capital backed company? Where do you usually see a firm like yours coming in?
Right. Well, when you're bootstrapping and burning your own startup capital, then every dollar is so precious, and it's probably too early to be spending money on outside services like mine. Also, the first checks, the first institutional money into a business, whether it's professional angel investors or really early stage VC funds, they don't necessarily expect that you have all of your financials buttoned up to full GAAP compliance at the beginning. They really just want to know that you're accountable for what you've been spending, that you are scrappy and can stretch a dollar further. But once you raise professional investor dollars, then all the focus is on execution and growth in your product. You're not in the business of doing accounting. You're in the business of building some cool tech that provides value to the industry and ultimately delivering a return back to your shareholders. So, trying to be something you're not and own the accounting and finance portion while you're also doing those other things is undermining your success on what the investor is investing in you for.
Yeah, and I would say we were definitely stubborn on our end. We probably waited longer than we should have, as most founders do. But it's very true. I think I would generally agree. Like once you raise any significant amount of initial venture capital, that's where it starts making sense to have a firm or somebody that that is an expert in this start helping you.
Also, if you're
Yeah.
going to be raising additional rounds of capital in the foreseeable future, like within 9 to 12 months or in the next year and a half, then now is the time to get your house in order and have all of your supporting data and thought process lined up so that it's not a mad scramble at the 11th hour to reinvent the wheel and go backwards and redo all the work. You should be building the rocket ship one part at a time without creating rework down the line.
Yeah, and I would say, some concrete examples in our case is reconciliation, like how you take care of all the expenses that you're having and also the revenue that you're generating, making sure that's reconciled, and cash versus accrual basis. There's a different level of lift between the two, but having a firm allows you to do accrual basis right more effectively, and that's ultimately what you need. Even small things like labeling what these transactions are, which again is part of reconciliation, but then how that funnels into your projections, right? These are all the things that at least I was doing manually, but I realized that the CEO should probably not be doing that manually forever.
Yeah, and it's an iterative process. So you
Yeah.
don't know, you don't have a crystal ball. You don't know exactly what's going to happen in the future, but you need to have continuity in your business intelligence. So if there's activities happening up here upstream and those are resulting in your financials, they should tell a story all the way through, and you shouldn't have to reverse engineer from the answer to understand what happened before.
Yep.
And so that's like, a way to think about accrual-based accounting is it's trying to tell that story in a way that has continuity all the way back to the source.
Yeah, and we talked a lot about VC-backed companies, but I know you've worked with a ton of entities that never raised venture capital. So curious what your thoughts are there. When does it make sense to maybe not raise venture capital, and how does that play, especially in light of the current markets in VC?
Sure. Well, for one thing, when you're taking money from anybody, whether it's a bank, a credit card, or an investor, it comes with a cost, right? And if you know, spend $1,000 on your credit card and you don't pay that bill off when you get it the next month, then it starts accruing interest. And by the time you pay it off over monthly installments, you might have paid $2,000 or $3,000 back because the credit card issuer is in business of making money, right? By letting you borrow their capital for a period of time. VCs are the same thing. It's not debt, it's equity capital, but they expect much larger returns because we all know that most startups fail. Abstract isn't going to fail for sure. I know you've got strong fundamentals, but that's the case. So VCs need to earn really ridiculously large returns relative to like what you're doing today. And so you shouldn't take investor capital unless you are committed and confident that you're going to be able to deliver those returns, because those are the expectations put on you when you take investor capital. You're going to need to grow fast, not necessarily grow at all costs, but grow smart and fast, because investor-backed businesses usually operate in competitive spaces. So if you're operating in a niche market where there's not a lot of competition and you can take your time growing off of your own cash flow organically, you may not need investor capital. But if there's other businesses in your space that have 10 times or 100 times as much money as you do, they might be able to outspend you and beat you to capture the market. So that's a risk.
Yeah, that makes sense. And I think now in the world of large language models, generative AI, a lot of this is shifting as well, because what used to take a lot more capital to accomplish is can actually be done for a lot less. So we're starting to see a shift, at least in our space, in the legal regulatory space, where we're seeing a shift in companies that traditionally would need venture capital to get to scale, but now can do so with a lot less capital.
That's always the case. Like Amazon Web Services came online many years ago, and you no longer need to buy thousands of dollars worth of
Right.
server equipment. You can just rent it on a per compute unit basis.
Yep. Perfect example. With the difference that, well, this is a whole nother conversation, but companies selling, so these new, applied AI companies like ourselves are selling into businesses and enterprises. The main sort of issue that a lot of startups like ours are running into is it's a new sort of disruptive technology, and there's a lot of buzzword or just buzz in general out there. So what's tough is actually educating the end user, which honestly was the case back when we first had the cloud be a thing. So that's a whole nother conversation. But actually ties into my last sort of question I had for you, which is how has AI impacted your space? Because of course we need to talk about AI and its impact in not only how you do your work internally, but the work you do for your clients.
Sure. Well, internally, we built some AI tools and trained some libraries so that our staff can ask questions and get good answers without having to, repeat the heavy lifting over and over again. And those models keep learning and growing. We're also experimenting with tools that help us with pattern recognition in like the data set. Human beings take a long time to look at large sets of data and identify exceptions to a pattern, but the AI can do it so fast and allow humans to focus their time and brain power just on the areas that need their critical thinking, and that's a big shortcut. But we're really sensitive to not put clients' confidential data out in the public data sets. So we're not using off-the-shelf AI tools willy-nilly because that's going to be a breach of confidentiality. Um, yeah, I think that answers your question, right?
Yes, and we'll see about that last point. There's actually a lot of new sort of architectures being built so that you can use sensitive information in a way that is secure.
Right.
But I think that's probably one of the biggest points of concern that companies have right now around these
Also,
models.
accountants are generally very accountable and they're expected to
Yeah.
be precise. And right now, AI is like a guessing machine, right? And it requires an extra layer of development and intention to be able to validate that the guess that you're getting from the AI is accurate enough to use as your work product for the accounting data set. Because if you're publishing information that is materially incorrect and you don't know it and your audience doesn't know it, you're setting yourself up for big risk of disappointment and failure.
No, totally. And I think, I mean, this is just, we call it the Wild West, but I would say in the next, even just year, 2 years, a lot of this is going um, to be a lot more concrete, even for the most sensitive of industries like accounting. So,
I fully
um,
believe it.
yeah. And my last question is, what are you excited about in the next 5 to 10 years in your industry or like the clients that you're working with? What excites you the most and or terrifies you the most?
Well, I'm really excited about the power of technological innovation and automation. Um, I get bored doing repetitive work, and I really enjoy doing the critical thinking and the like asking, so what, and what do we do about it? So I love that technology is more and more able to take care of the busy work and enable us humans to talk about the so what and what do we do about it.
Which I had talked about in a previous webinar with Abi Nemani, who's one of the initial founders of Code of America. He was talking about how Web 2.0 brought us to a ton of productivity at the expense of a ton of noise. So it allowed us to, host things on the cloud, have things like Slack, email be a lot more usable. So we're able to increase communication, right? And the cadence at which we communicate with people. But it was at the expense of noise, right? I mean, everyone's inundated with notifications. So the interesting thing about what AI is going to enable us to do is actually to your point, which is automate and help reduce noise across various sort of mediums to allow us to focus on higher level, more strategic work again. What I do worry about, well, what I always talk about is not necessarily worry, just a question about what's going to happen with the current makeup of jobs and roles and responsibilities. Because again, with any disruption, with any technology that disrupts, there's always going to be a disruption of jobs and roles, which I'm actually curious, like, what are your thoughts on that?
There's definitely going to be disruption for job. Robots are coming, right?
Yeah.
So that's inevitable, and it's really just about staying ahead of the curve, riding the wave, or even creating the wave, and being a part of the solution. That enables the humans to level up and use the technology to their advantage instead of being disrupted.
Yeah. No, and with time, like we're gonna see a lot of things change as always, and there will be friction points, but that's what we do as humans. So, anyways, yeah, you're gonna say,
Well, and ed tech and government tech is in a challenging space because
yeah,
those institutions have a lot of compliance regulation that are like setting their expectations that things have to be the same as they were before and you have to do things this way, so they're resistant to change and they're afraid of failing and missing those expectations. So you have a higher educational hurdle to get those customers to understand how technology doesn't undermine what their expectations are in their work, but enhances or enables them to do it better, faster, cheaper.
yeah, I would definitely agree. education's needed across all types of customers, but especially what we've seen selling to government and in that space, there's going to be a whole nother layer of education needed there. So this was great, Mark. Really appreciate you taking the time to join us on this webinar. And if people want to learn more about you or what your firm does, where can they find that information? LinkedIn, website, what do you prefer?
Sure. Look, the company website, Supercharger, spelled without the vowels, sprchrgr.com. I have my own online CV. It's mwald.com, mwald.com. You can find me on LinkedIn. It's the internet age. You can find me anywhere.
Yeah, just like I said, he's a celebrity, at least in Los Angeles. So just Google him and he'll show up. But thank
Thanks.
you again. Bye.